Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast presented by Tusk Media. Real quick, show some love on Twitter at Tusk Media LLC. Send us a DM, we'll send you a free Tusk sticker. It's got the whale, it's a narwhal, so it's got a tusk, it's got headphones on that also look like an exclamation point. So check that out. Also subscribe on iTunes, YouTube. If you're on Seeking Alpha, leave us a comment, all that good stuff. I am Andrew Hall. Joining me as always, Ben Nye. Ben, how are you?
I'm doing well. I was just thinking, we're pretty understated in the name of the business. Tusk Media, and yet we're giving away stickers, which is a tusk and a whole whale headphones. So check it out.
Big in the sticker game right now. So we're doing way more than the tusk right now.
Yeah.
So check it out. Show some love. Send us some DMs. We'll hook it up totally free. We'll even pay the postage. So today we're talking about JP Morgan. Going to do a little bit of a kind of a SWOT analysis, talk a little bit about through it, do a little bit of a end of the year review, and that's probably the best way to start off is just talking about what the stock has done. Yeah,
so the stock performance has been absolutely incredible ever since the London whale a few years ago, which is when a trader in London took undue amount of risks, and I think it ended up being like about $6 billion.
Just a little.
But since then they've really rebounded pretty nicely. They've been doing well on the trading revenue front, and the stock has been responding extremely nicely, especially since we had the bottom out in rates in the summer time frame, and since then it's been kind of run for the roses. In JP Morgan shares. Yeah, and potentially more good news for rates. We'll touch on that in a little bit, and as we kind of keep going. So jumping off, talking a little bit about the strengths of this company, what do you see there in terms of management, market share, everything kind of across the board there when you're looking at JP Morgan? Yeah, well, you can't really talk about JP Morgan and not talk about Jamie Dimon. Yeah. He's so out there in terms of it's his company. More so than any other CEO of a large bank. I mean, you don't say the same thing about Brian Moynihan. You certainly don't say the same thing about Mike Corbat at Citigroup or Wells Fargo, which is having a complete revolving door in terms of its management. Even Lloyd Blankfein at Goldman Sachs, he's more understated and kind of defers to his various people. But at JP Morgan, it all comes down to Jamie Dimon. And he's been called the best banker around, best risk manager around, and that kind of threw everything for a loop when they did have the London whale issue.
Very uncharacteristic.
And then some people were saying, well, maybe Jamie Dimon isn't the wizard. Maybe it's just a guy behind the curtain. Yeah.
So he's the wizard again.
Yeah, that's true. So he's having great performance now. He was talked a little bit about for Treasury Secretary at one point, but he's staying at JP Morgan, and he's dealt with Fed regulators a while, and so the analyst community feels very comfortable with him at the helm. And JP Morgan as a whole has continued to expand. They have a very large market share, especially in the United States. Both them and Wells Fargo were really the two darlings. Now it's almost just JP Morgan. So that kind of brand value coupled with the management is definitely an asset for the company. Intangible asset, but something that does add value over time.
Yeah, it's definitely robust, definitely recognized, kind of as you said, he's not just a figurehead, he's the face. Right. Which is kind of a rare combination, especially on Wall Street. To be viewed with such respect. In terms of market share and what they're doing with diversification, things like that, kind of a leader there as well.
Yeah, well, they have a very diversified business. I mean, you look at Citigroup, which is much more heavily tied to like fixed income, and also they have emerging markets. They have diversification in that aspect, but
they're trying to get simpler.
Right.
We talked about that recently.
Right, but when you talk about JP Morgan, especially in the United States, they're much more diversified vis-a-vis a Wells Fargo. Wells Fargo is very levered to the housing business, which has really helped them in terms of return on assets because they've been able to make more money off of doing mortgages, but JP Morgan is less exposed. So let's say there was another housing crisis. In my view, Wells Fargo would be hit significantly more than a JP Morgan.
So one of the flip sides is we kind of transitions a little bit to some of these weaknesses or challenges, however you want to view it. You know, one of the challenges of tons of diversification of your business is the complexity.
Yeah.
What are you seeing in terms of threats to that diversification and some of the byproducts of it?
Yeah, I mean, a big thing is model risk. So when you have a larger and larger banking organization, you're playing with more and more fire. So you see the same thing at Deutsche Bank, who his business just exploded. It's huge, and you know, you make one error in a model, and all of a sudden everything that was supposed to be hedged is turned out not to be hedged. Your risk controls can go, and as much as Jamie Dimon would like to have his fingers in all the pies, I mean, he just can't.
He's only got 10 fingers.
He's only got 10
Last
fingers.
time I checked.
And you know, $2.2 trillion in assets. Yeah. So you know, it's just, you're dealing with uncertainty, and whenever you're dealing with uncertainty, if something bad happens, if you have a larger amount of assets, it's going to be worse than if you had a smaller amount of assets.
Kind of along those lines, you know, uncertainty. One of the things that seems hard from an investor standpoint to anticipate is the challenges of regulation. To some extent, you know, obviously we saw some of the issues with Wells Fargo, kind of showed some cracks in their armor, late summer, early fall, so to speak. What are some of the regulation challenges specific to JP Morgan or the industry as a whole? That's number one. And number two, what do we see under Trump? Does that create an opportunity?
Well, I think up till now, what you've seen is arrogance has been punished. The Fed does not enjoy when bankers get a little cocky, and that's what we saw with Wells Fargo. And they much prefer when a banker is subservient and defers to the regulatory authorities. You've seen this at Citigroup. For example, Citigroup was the only bank that passed the living will test earlier this year in April. Wells Fargo failed, and that was kind of a precursor to when the issues that all came to a head this fall when Wells Fargo was creating false accounts. As far as JP Morgan goes, relative to a Trump administration, you'd think that the regulators would ease back a little bit, some of the unnecessary regulation. Nevertheless, I think that regulation is here to stay, but I think it'll just be easier to deal with the regulators. It's important that JP Morgan and Jamie Dimon recognize this and respond to it and adjust their business accordingly, but I don't think they'll have to make large-scale changes the way they might have had to if Hillary Clinton won, and certainly if Bernie Sanders did won the election.
Yeah, and that's one of the things, you know, Trump in his 100-day plan, he lays out this concept of, hey, for every one page of new regulation that comes out under my administration, I almost called it a regime, which probably would have been a little bit too intense, but for every new page of regulation, he's going to pull back to. We'll see how viable that becomes as an actual strategy. I mean, my hope is that that just means he's using smaller words or something like that.
Right.
But at the same time, there's kind of an attitude, wouldn't you agree, to the enforcement of regulation. I know a lot of times when we talk to our compliance advisor, we've got one in office and one up in Boston, and she always talks about, you know, we talk about the SEC, Securities Exchange Commission, and, you know, we're under their rule. Because Narwhal, the parent company of Tusk Media, it is a registered investment advisory firm. So one of the things she always talks about is the attitude of the SEC, which sounds odd. You know, you think about these rules and the enforcement, so it should be black and white. But the reality is they do kind of take on their own personality traits, kind of their own characteristics by leadership, and that is passed down. So it does seem like the attitude towards these regulations will shift to be a little bit more, I don't want to say casual, but potentially less aggressive under Trump. Would you agree with that assessment, that paraphrase?
I think it will be designed to be easier for the banks to meet.
Yeah.
I think it'll be much less ambiguous.
Set up success.
Yes.
A little bit more.
At least we can hope.
Right, exactly. And then another big opportunity, and we've talked about this some in PM meetings, is really just the whole wealth management business for JP Morgan, just in terms of building that out, continuing to grow that. Where would you place their wealth management business, you know, relative to maybe some peers?
Well, I think what they're doing is they have a pretty big retail business already. So, and you're seeing this at Wells Fargo, but Wells Fargo has been kind of stunted, and they were pressing it too much. What JP Morgan's doing, they're out there, people know about Chase, and they're really trying to create this ecosystem whereby they can continue to gather assets, continue to gather accounts. And as we talked about earlier today, that wealth management business, even if it's just tax planning, can be quite useful for clients, especially high net worth clients.
Yeah, absolutely. Yeah, we did a video on tax loss selling and harvesting tax losses and that kind of stuff, so check that out. But yeah, exactly to that point. I mean, at the end of the day, I think clients view wealth probably one way. The stance of JP Morgan should, as a bank that's dependent on assets, should always be, we care most about after-tax assets. And if they can kind of impress those things upon their clients proactively, even in an area small as that, it can have a really big impact by minimizing taxes. And the other opportunity we touched on earlier in this podcast really is the interest rate hike. By the time this video goes up, we'll probably have already heard from the Fed. It's coming up in real time in about 15 minutes, but this is going to be on a tape delay because intern Garrett's slow and steady. But so that's the other opportunity, and I think we're seeing the financial sector as a whole kind of run with that as well as with the market as a whole. So I don't know if there's too much unique to JP Morgan to add there.
No, not too much unique. I think they'll definitely be helped by it. But then you're also thinking about what does the curve do, and what's their interest rate spread going to be? Because if they raise the short end of the curve, but the long end drops even more, then your spreads actually can compress and you'll have less revenue. So keep an eye on what the 30-year and the 10-year do as well.
Yeah, and just kind of wrapping up some threats here, and then we'll move on really to your analysis of the stock, your investment approach, so to speak, at this point. What threats do you see specifically to JP Morgan?
Well, the threats I see, continue to be regulation. You still don't know what's going to happen with Dodd-Frank, but primarily it's going to be twofold. The first is a macro factor, and that's just recession. That's kind of what we're talking. It's kind of tied to interest rates, so I don't want to belabor that. That's relatively obvious. But also the management issue. What is their succession planning going to be with Jamie Dimon, and how much uncertainty is that going to create? Because not only do you have the optics of a manager like that, but you also have Jamie Dimon has been so out there in terms of talking to all the people in his industry. I'm not sure how much he has actually delegated to some of his underlings. And for that reason, when you're dealing with the Fed, all of a sudden you're going to be dealing with the Fed with a new CEO. And that could create differences in approach and potentially more regulatory pressures and more misunderstandings.
So JP Morgan, again, to kind of recap, we're talking about a stock that's had a great run. It's a very diversified business model that comes with some challenges. Regulation remains kind of a little bit of an overhang for all the banks, and we're in a sector that's had a nice little run because of interest rates. You buying here, you selling here, you holding tight. What are you thinking?
I think it's difficult to sell here given the taxable gain. I do think it trades at a premium to the majority of the banking space, with the exception of Wells Fargo, and that is on a relative tangible book basis. I think it's at about fair value here, given the economic environment. I think Citigroup is under fair value. I think Wells Fargo is at a premium to fair value, and Bank of America is slightly under fair value. But for JP Morgan, it does justify that premium, I think, to tangible book value, because it's just proven to be better at managing some of those risks. And I think that we talk a lot about in the asset management industry how people are concerned with what is the process over what are the returns. And I think that is increasingly becoming more popular when you analyze a bank stock relative to, Wells Fargo didn't have any problems, so people were saying it was well managed, but that was more of a leap. You could obviously see what happened was the processes were weak. With JP Morgan, I feel confident that the processes are strong. They've shown strong asset growth. Their capital ratios are solid. And their asset growth is actually some of the best in the industry at 4%. Return on assets is pretty strong. But right now, both of those are kind of at their long-term median and average lines.
Mm-hmm.
So you have to think of a different view in order to see outsized returns for JP Morgan going forward. And that would mean, in my opinion, you'd have to become more bullish that the U.S. economy is going to accelerate.
Right.
So if you're of the view that the U.S. is going to post 3% plus real GDP growth and maybe like 5% nominal GDP growth in 2016 and then 6% in 2017 and then 6% in 2018,
Load up.
then JP Morgan's an excellent stock because it's extremely well levered to that.
Mm-hmm.
But if you're of the view that it's still going to be 4% real nominal GDP growth and then 4% nominal GDP growth and then maybe there's a risk of a recession, then probably don't want to add to JP Morgan here. But unless you're really seeing that the economy is going to decelerate, I would not be selling either.
There you go. So kind of you're in the hold. There's a
Yeah.
case to be made really on the macro situation for either buying or selling.
Yeah.
So kind of follow your conviction there. This is the Investing Podcast. We're going to be coming at you with a lot more stocks over the next couple weeks, and we're also going to do some sector reviews. So hit subscribe on iTunes, subscribe on YouTube. If you're on Seeking Alpha, give us a follow. Show us some love in the comments. Thanks.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.